Opendoor Technologies, ticker OP, is trading live at $7.21. That is a sharp drop of 8.10% on the day, or 62 cents, as we are live during the November 6th, 2025 trading session. The stock opened at $7.15 and has been in a volatile channel between $6.84 on the low end and $7.52 on the high end, with heavy volume of nearly 75 million shares already changing hands. This aggressive high-volume sell-off isn't happening in a vacuum. The entire market is holding its breath for what happens after the closing bell tonight, because that is when Opendoor is set to report its third quarter 2025 financial results. The reason for today's plunge is that investors are bracing for impact. The expectation set by the company itself is not a positive one. Management already guided the market to expect significantly lower revenue, projecting a range between $800 million and $875 million. This would be a stark drop from the $1.6 billion in revenue they posted in the second quarter. More concerning, they signaled a return to adjusted EBITDA losses, forecasting a loss between $21 million and $28 million. After clawing its way to profitability, this reversal is precisely what investors are selling off in anticipation of. The common belief around Opendoor has been one of high risk, high reward. This is the last man standing in the iBuying space. After Zillow and Redfin spectacularly exited the business, admitting the model was too difficult to manage, Opendoor became the de facto flag bearer for the entire concept. This narrative, combined with its heavily beaten-down price, turned it into a favorite among many retail investors, who saw a potential monopoly in the making. The stock has seen a blistering 500% run-up this year, driven by this belief that if they can just survive the frozen housing market, they will own the future of real estate transactions. This is the expectation: survival, then dominance. The reality, however, is that the business model itself is what is on trial in this macroeconomic environment. The iBuying business, which involves using massive amounts of capital to buy homes, lightly repair them, and resell them for a thin margin, is exquisitely sensitive to interest rates. When rates were at zero, Opendoor could borrow cheaply to build its inventory. In today's high-rate world, their cost of capital is enormous, and the housing market itself has seized up, with transaction volumes at 30-year lows. This is the fundamental tension. The market is trying to decide if Opendoor is a coiled spring waiting for rates to drop, or a flawed business that was only viable in an environment of zero-cost capital and rapid home price appreciation. Today's 8% drop suggests that heading into earnings, fear is winning. Investors are looking at the company's own guidance for a 38% year-over-year revenue collapse and are not willing to wait and see if there is a positive surprise. They are voting with their feet. The volatility in this name is staggering. The stock has registered over 98 moves greater than 5% in the last 12 months alone. This is not an investment for the faint of heart, but a battlefield for bulls and bears. The bulls are betting on the long-term technological advantage and the last man standing thesis. The bears, on the other hand, are looking at the math. They see a company that is unprofitable, burning cash, and operating a model that requires a healthy, high-volume housing market that simply does not exist right now. This brings us to the significant pressure from short sellers. This is not a small fringe bet against the company. It is one of the most significant short positions in the entire market. As of the last reporting period in mid-October, Opendoor had over 161 million shares sold short. This number has been steadily climbing all year, up from around 70 million back in March. This indicates a deep conviction from institutional players that the stock's 500% rally is pure speculation detached from reality, as one Reddit discussion framed it. The short thesis is straightforward. Opendoor's model is fundamentally broken in a market where home prices are flat or falling and financing costs are high. They believe the company will have to continue burning cash to hold its inventory, and that the weak guidance for Q3 is just the beginning. What's your take on this massive bet against the company? Is it smart money seeing the flaws, or are they underestimating the last man standing? Now, for those of you watching this, it's important to understand how to interpret this short-selling data correctly, because it's not always straightforward. You can find this data on exchange websites like NASDAQ or on financial platforms like Fintel. The first figure, 161 million shares, is the raw short interest. But the next metric is days to cover, which for Opendoor is only about 1 day. This is because the stock's average trading volume is so high, often exceeding 100 million shares. This low days to cover number means that if the shorts wanted to buy back their shares, they could do so in a single trading session without causing a massive sustained squeeze. This is a critical detail. A high short interest with a high days to cover is the explosive combination for a squeeze. Opendoor only has one half of that equation. Furthermore, we can look at the cost to borrow. This is the fee short sellers have to pay to borrow the shares they want to sell. Right now, the borrow rate on Opendoor is incredibly low, at less than 1%. This tells us that even though 161 million shares are shorted, the institutions that lend stock are not finding it difficult to locate shares. There is no scramble, and it is not expensive to maintain a short position. This suggests the short trade is not crowded or desperate. It's a large, liquid, and relatively cheap bet being made by major funds. This isn't to say a squeeze can't happen. A massive earnings beat tonight could certainly trigger a panic, but the underlying mechanics do not support the kind of sustained, multi-day squeeze seen in other meme stocks. As an investor, you need to be aware of this. You should also monitor fail-to-deliver data, which is published by FINRA. If you see a persistent, large number of FTDs, it can indicate stress in the system. But for now, the primary signals are the sheer size of the short interest versus the very low cost and low days to cover. What Opendoor actually does is, on the surface, simple. It runs a digital platform where a homeowner can request a cash offer for their house. Opendoor's algorithms analyze market data and provide an offer, often within 24 hours. If the seller accepts, Opendoor buys the property, makes necessary repairs, and then lists it for sale on the open market, aiming to make a profit on the flip plus service fees. In the past, this was a volume game. They were buying and selling tens of thousands of homes. But the macro environment has put a stop to that. The company's own guidance proves that their acquisition and sales volume have fallen off a cliff. The company's future outlook, therefore, is entirely binary, hinging on two things: tonight's earnings report and the future path of interest rates. Tonight, investors are not just looking for the headline revenue and earnings per share number. They will be dissecting the contribution margin per home, the total value of inventory Opendoor is holding on its balance sheet, and how quickly it is managing to sell that inventory. The most important number, however, will be the guidance for the fourth quarter. If management signals that Q3 was the bottom, that margins are improving, and that they see a path back to growth, this stock could fly, burning the shorts. If the guidance for Q4 is just as weak or worse, it will confirm the short thesis, and this 8% drop could be just the beginning. Looking further out, the bull case requires the Federal Reserve to begin cutting interest rates, which would lower Opendoor's capital costs and, in theory, thaw the frozen housing market. The bear case is that even if rates fall, the iBuyer model's thin margins will be eaten alive by any market volatility, and that the company will ultimately be forced to dilute shareholders by raising more capital to fund its burn. Opendoor is trying to manage this narrative. Their earnings call tonight is being presented in a new financial open house format, an explicit attempt to reach their wide base of retail investors and answer their questions directly. This is a smart public relations move, but it won't change the underlying numbers. The expectation, fueled by a 500% rally, is that Opendoor is the future. The reality, presented by a 38% guided revenue drop and 161 million shares short, is that the company is in a fight for its survival. Tonight, we find out which narrative gets the upper hand. Opendoor reports earnings tonight, and they've guided for revenue to land somewhere between $800 and $875 million. Comment below with your estimate. Do you think they will beat their own lowball guidance, or is this the quarter the iBuying model finally breaks?